Good afternoon, everybody. Welcome back to Schwab Coaching for our next topic, getting started with stock investing. I'm your host, Kevin Horner. Thank you all for joining me today. Pleased to be joined by my friend and fellow Schwab coach, Mike Fairborn. Connie Hill in the chat today. Connie is going to keep an eye on things in there, and I see a couple of familiar names in the chat already. So BJ and David, glad to see you both here. Thanks for joining us. And of course, we want to get down to business today, covering a fairly important topic, obviously, but we are going to be embarking on a full year together as we go through this, getting to be familiarized with stock investing and kind of learning the foundational approach, if you will, to the stock market, what it's all about here, and various ways that investors might go about putting their money to work in the market for a number of different reasons. And so that's pretty much the plan, the process that we're going to go for this year. There's going to be a lot to cover as we do it, but we're going to segment out going forward here some of this discussion into bite-sized pieces for you. Now, today in particular is going to be relatively generic in nature. And what I mean by that is we are going to set the table for our subsequent sessions where we really get into the meat and potatoes aspects of these individual areas of the market we want to talk about. So today, like I say, you can certainly bring your questions to the table. I'll work to address them with you, but I want you to realize that as we go forward, many of these individual segments we will be using to delve deeper into the discussion and really flesh out the whole process you want to know about. So the good news is, as we do that, of course, you're going to have an archive available for you on a week-to-week basis here. So we'll be hosting this one every Thursday at the same time, 3 p.m. Eastern. So you can set your calendar right and be here with us live, or you can, of course, catch this in the archive. Either way works great for us. Make sure that you take advantage of your opportunities to chat us up, though, as well, whether it be here in the chat. You can also in the archive when you are watching these on a after the fact basis, you can make comments there as well. Those come directly to me. And if you'd like, and we would certainly encourage this, follow us on X. Connie Hill CS and Kevin Horner CS. You can send us questions and comments there as well. It's a great way to get with us coaches outside of the traditional sessions we host for you all. So with that, let's cover a couple of more key disclosure details, and then we're going to get into the basics today. So first of all, I'll remind you, of course, that the discussions we host here are fully informational and educational, meaning we do not make recommendations. We do not endorse necessarily a particular approach to trading or investing in the marketplace. We do want to give you the view that you have a lot of options available. What we want you to do is to find the area or the avenue for you to invest or trade in the market that's going to fit you and your approach, your comfort, your tolerance for risk, etc. In terms of what we work with here, we are going to be periodically in today's class minimally looking at the Thinkorswim desktop application, just as a means of kind of highlighting trends and basic trend analysis here, everybody. But remember that we do that in a demonstration mode of the Thinkorswim desktop application, and you have access to that paper money platform. You have access to that live money platform as well if you are Schwab client. So bear in mind that we work in that paper money version exclusively here on our shows. So as I mentioned, today will be a little bit generic in scope as we are going to cover some of the basics, but this is ultimately what the series is designed to provide you all in terms of education. So we will delve into the idea of investing for growth versus investing for value, what that may mean to the individual investor. Technical analysis can be a key component for traders for sure, but even investors can find merit to technical analysis and understanding the standard basics of trends and trend analysis. And that's where the technical aspects will come in handy. We'll also discuss entry signals, when to put money to work in your portfolio. And this will differ greatly whether we're talking about trading versus investing, whether we're talking about investing for income opportunities versus maybe investing for growth opportunities. There's a lot that we can talk about here to really get you a full understanding of when it makes sense to be looking for that trade opportunity versus exposing money to the portfolio in an area of the market that might be undervalued at any given moment in time. Those are going to be things we talk about as well. We're going to definitely talk about risk management. A key component for many of you as traders, and if you've seen many of my older classes, you know I'm a very big proponent of risk management for trades, individual trades, that is equity positions. Risk management is key, and we incorporate that into our exit strategies when we trade. But one of the things we're going to talk about in this series as well is an understanding that if you are investing for the long haul, think 10 years, okay? 5 years, you can even go as little as 5 years thinking down the road, 5 years, 10 years, 20 years, etc. Investors don't mitigate risk typically through the use of exit strategies. They commonly employ risk mitigation technique through diversification, which is to say, putting their money to work in a multitude of avenues and areas of the marketplace. So rather than, for example, just as a generic view, rather than incorporating stop orders as means of selling stock, traders, or that makes sense for traders, right? But an investor may very well just say, I'm going to put my money to work in these groups when the trends look overdone to one area, to the downside, for example. They will deploy money to those groups in a means of diversifying their portfolio. And it's that diversification that provides risk mitigation to the long-term investor. So having money exposed to all, for example, the 11 categories, the 11 sectors of the U.S. market, if you're thinking, from a sector relationship, you could also think about it from an asset class relationship, right? Large cap, small cap, international components, fixed income components as well. We'll talk about all of that stuff. So top-down analysis is a big part of the long-term investing viewpoint as well. Again, kind of providing the idea that we start broadly and whittle our way down into understanding which groups are leading the broader market. So we might have, for example, we had a wonderful 2024 with the S&P 500. The S&P did tremendous, up 24% after another 20+% year in 2023. So we could start large caps and whittle that down. Which were our leaders in those windows of time? And that can be in a way that traders and investors alike will expose money to their overall approach. So definitely need to understand time frame, everyone. Time frame is paramount as traders, but we're going to cover that as well. It's an important aspect of defining who we are and how we individually want to approach the market. So my hope is that I provide for you all a multitude of ways to think about things, and then you get to pick and choose which of those thought bubbles fit you, right? Which ones are the approach that you want to incorporate with your overall plan. So here's the agenda that, like I said, we're going to cover a little bit over the few weeks. Now, today specifically, I want to get to the understanding of what is a stock. I mean, how basic do we need to be? We should probably cover what a individual stock reflects, right? So a stock share, as we often point out, is a single piece of representation and ownership in the underlying company. Of course, not everybody is interested in owning just one single share, and surely many investors will buy hundreds, if not thousands of shares to reflect that ownership. But remember that really what we try to pay attention to from an investment standpoint, isn't the amount of share we have, but rather the percentage of investment we have relative to our portfolio. So not necessarily important to think of what is the percentage of ownership that I have in Apple stock, for example. I'm not concerned with that. What I am concerned with, perhaps, is what is the percentage of ownership in Apple as it relates to the rest of my overall portfolio. That's where we get a better understanding of my tolerance for risk, my comfort for being invested in the overall markets, etc. So yes, a single share of stock, a couple hundred shares, a couple thousand shares, that is reflective of the owner's position in that underlying stock, a piece of ownership in that underlying stock. And so the common thought, as I'm sure many of you have heard, is to buy stock when it is low in price and sell it when it is high in price, right? That's the appreciation viewpoint. The idea being it is at any given moment, maybe appropriately valued. It might be undervalued. It might be overvalued. And investors and traders alike will consider these concepts as they decide should they be adding more money to a given investment or maybe pulling some of those investment dollars off the table. Okay, so stock appreciation, certainly the way that a trader most commonly benefits from investing in stock, right? Buy the stock at a time they think it's undervalued, and hopefully they can sell it hours, days, weeks later at a higher price. That's the stock trader's view. Now, commonly, if you incorporate a longer window of time, you might be working towards dividend investments or dividend payments. And this can come to a single portfolio on a monthly basis. It might come on a quarterly basis. They might come on an annual basis. Every dividend payer is a little bit different in that way, but not every stock pays a dividend. And not every stock that pays a dividend will continue to pay a dividend. So dividend payments are absolutely one way that a type of stock is designed to create value for its owners. Not every stock is going to do it, and not every stock can continue to do it. And we'll talk about that as well going in, because dividend payments, for those who are dividend investors, it is imperative that the stock that paid the dividend continues to pay that dividend. Otherwise, the dividend investor has no reason to stay with that stock, right? So an investor who buys stock for the purpose of a dividend is going to consider a dividend yield. A, how frequently do they pay it? B, what is the percentage relative to the underlying stock? And is that percentage maybe higher or lower than what an investor could get from, say, for example, a risk-free rate of return, which could be offered through something like a simple treasury note, paying in the neighborhood of 4.5% right now. So many investors would actually ask themselves the question, why would I buy a stock XYZ paying 3% dividend that has the opportunity for capital appreciation, but also capital risk? Why would an investor maybe consider a stock like that when they could just buy the same dollar value of a U.S. Treasury paying 4.5%, which then has no risk factor at all, right? Just a guaranteed 4.5% implicitly backed by the U.S. government. So that's a common thought process that investors need to consider when deciding, now I'm going to deploy this money to the market, or I want more exposure to equities. These are concepts that a trader, or rather an investor, really needs to consider. So as we work forward and kind of get to a better familiarity with this, yeah, we're going to cover that as well. Dividend payments being a big part of that for you long-term investors. And of course, remember, as a dividend investor, not everybody is paying that dividend out. Many of you might be accepting that dividend and reinvesting it into shares of that same security itself, right? So if you are looking at building long-term equity positions, many long-term investors who aren't taking distributions yet, which is to say you're not at that age where maybe you're taking money out of a long-term retirement account, for example, those investors might just be building the portfolio through those dividends, right? Every time a dividend comes in, it automatically buys new shares in that underlying stock, and it builds and compounds that position within a portfolio. All right, so as I noted off the jump, we are going to flesh out these three investing styles as we go forward. Growth investing, value investing, income investing. We just got done kind of touching on the concepts behind income investing, right? Utilizing the individual equities that pay dividends and understanding that some of those dividends are going to be paid at lower rates than others. And some of those times you may want equities so that you get long-term growth opportunity from the underlying stock as well. but can also lead to risk factors, right? That's why a trader or an investor rather might want something a little more fixed in nature. Now, growth investing here really gets into the recognition that we can't necessarily assign true value to stocks that aren't yet making money, right? Many times you will find stocks out in the marketplace, these growth stocks that don't have positive balance sheets. They are small companies in nature. They might not have a sufficient amount of capital with which to work. The capital they do have may be from loans, right? From bank loans. And if they are small cap investors, small companies, this can be a bit of a challenge, especially in a rising interest rate environment where rates keep climbing and the small company has to continue to pay higher not necessarily fees, but higher interest on loans they have already taken out. This can be a problem for these so-called small companies. So growth investing, though, is much more tied to maybe investing in trading on potential momentum-based moves, perhaps, whereas something like the value investing is going to be tied to that true balance sheet, meaning does the company have cash on hand with which to work? Okay, is the company in good health from that standpoint? And things like many investors want to see large cash on the balance sheet, whether they pay a dividend or not. Does the company have any debt on its books? Is that debt associated with short-term windows of time? Is it associated with long-term windows of time? So value can also be reflected in the form of something as simple as price to earnings ratio as well. What is the stock's price per share relative to how much earnings per share it pays out? And that can be a common, it's a very long-term and often utilized viewpoint for a so-called value investor. The trick, as I think what we've maybe seen of late, is that the value investor doesn't always feel good about buying those stocks when they are undervalued. Commonly, undervalued stocks look terrible on a chart because they are trading at depressed values, which is perhaps increasing price to earnings ratios, or perhaps price to sales growth, another way that some investors want to consider the health of a company from the value standpoint. So yeah, growth investing, value investing, income investing, all of these carry different approaches and notably different time frames quite frequently. I would suggest from the growth standpoint, many investors who like to invest for growth are thinking a window of time, maybe in that 3 to 5 years. And the reason I say that is that you might consider a stock in its infancy needing to continue to grow, right? Getting through the first 3 to 4 or 5 years and taking steps to become a mature company who is getting out from beneath some of those debt requirements that many startup and new companies need to continue to do business, right? And once you get out of that growth phase, then you can start to become a more value-oriented investing company, a company that people rely on for long periods of time, and they think of that company as someone that just continues to provide value to them. I think about it historically. I've been investing in the market since 1997, and Apple was a big part of the run we've seen in my 27 years, but Apple was a growth company for the first decade plus of my tenure in watching the market. But many would suggest that Apple is not necessarily a growth company at this time anymore. Like they've already made the leap to move out of a growth investing company, right? Apple now sits on an incredibly deep balance of cash. They have a healthy pipeline of both individual services that range from the phones to the laptops, etc., all the way to the services and all of that, not to mention the streaming service too, right? So there's a ton going on with Apple at this point that makes it very different than it was when I first started got going in investing. And so these individual companies will maybe move through a phase like growth, become a value investing stock eventually, or maybe they shift into an income investing standpoint, right? Maybe they become one of these true stalwarts that continues to pay a dividend consistently. Now, one of the other things we have to talk about as we go forward here, everybody, is the discrepancy between technical analysis and fundamental analysis. And, you know, they are different, but they are not diametrically opposed. These are different philosophies, but they can absolutely work in concert with one another. So technical analysis, this is the study of trends. This is, simply put, we look at where price is relative to where it has been. And historical price action, trend analysis can help the investor decide when to deploy money to a given group of the market, certain individual stock in the marketplace, etc. Whereas the fundamentals are maybe going to be what builds a watch list of securities for you to then consider the technical aspects on. So it's often stated that fundamental analysis is the which securities do I want to consider for my investments, and the technical viewpoint offers you the when to consider those individual stocks. And so one of the things that I want to make sure we do today is I'm going to migrate us over here in a minute to the Thinkorswim desktop application. And I'm going to highlight a couple of watch lists that are immediately available as public watch lists to all of you. And we're going to also work towards building and maintaining watch lists in this class and to take advantage of proper technical setups that are appropriate from an example standpoint, of course, appropriate for the investor who is interested in growth opportunities versus interested in value opportunities versus interested in maybe income generating opportunities. So, you know, yes, it can be said that you can always find the right time to be putting money to work. And it might be a little more difficult to do that with these so-called income generating strategies where, you know, you're wanting to buy a stock because it pays a good dividend. You might not be as concerned about the technical aspects about that, but from a value proposition or a growth proposition, it absolutely becomes important when we start talking about positioning and putting on an investment or starting a new investment, et cetera. I think there's plenty to get to as it relates to all of that. Okay, so let's kick it over. I'm going to kick us over to Thinkorswim, and we're going to take a peek at Thinkorswim desktop here, everybody. And what I've got up is the S&P 500. Seems to be a little bit in the red for us today. We're off about 0.2%. And one thing that we might note, if we just took a quick look here, we start talking about trend analysis. This is more the technical aspect from a kickoff spot, everybody. But let's just keep it generic here. Lower left to upper right. That would be called an uptrend, right? And we would define the uptrend commonly as a series of higher lows. What's a higher low? Let's call them out. We got a higher low here. So this is the low right where we started last year. This is the first next low came in here. We then made, or I should point out, we made a high, right? So we have a higher high, higher low. Now we have another high here. This is could be considered a higher low in a short-term scenario. And then we have another higher high way up here, followed by that low. Now, this is where we start getting into time frames, right? If you were the short-term trader, this would be considered a lower low than this low, okay? So that might seem notable to the short-term trader, but the longer-term trader would point out that is still higher than this low back here, and we could point that we've got, if we decided to use that low back there, we might say that we had a trend kind of like that. So we were below this trend line for all of a couple of days before it got recaptured. So then do we see the continuation of that? Do we get more higher lows along the way? We sure did. So we've got one there, another one here, and we hope we are making higher lows right now. And I say we hope because we are seeing that we've got a little deterioration in this trend in the short term, but not much, right? So we're not looking to define this. We don't know what's going to happen next. We could state that much. But what we are looking maybe to do from this technical viewpoint is just to define what would it be that would make maybe an investor consider doing something differently or making a change, or maybe saying, well, I've been waiting to invest in the S&P 500. Is now the right time? Or is there a price where I would be much more comfortable to add? Many investors would say they'd like to be a buyer closer to an average price over a longer window of time. And that's where these flowing colored lines come into play, everybody. So we have an orange line, a purple line, and a blue line down below. So this orange is the 20-day average price. We call that the simple moving average, or SMA. We call this one the 50-day. And that's by my definition of them, of course. I have defined my moving averages as such. And then we've got the 200-day moving average down below. So from a trend analysis standpoint, right now, we can say that in a window consistent with 200 trading days, we remain in an uptrend because we have higher highs and higher lows, and we are trading above that 200-day moving average. Now, these lines, these moving averages, these are calculated by taking the closing value of, in the case of the 20-day, taking the closing value of the 19 prior sessions and the current or last trade right now, and adding them up and dividing by 20, and that's that value right now. 6,000 essentially, right? Yeah, 6,000 almost on the nose is our 20-day moving average at this point. And we do the exact same thing with the 50-day. The 50-day is 5,555 right now, or excuse me, 5,942, pardon me, but it's doing the exact same calculation. 49 prior closes plus the last trade right now, and dividing it by, combining it all, adding it all up and dividing it by 50, that gives us the 50-day simple moving average. And then we have the exact same calculation to create the 200-day using the last 199 closes and today's last trade, add them up, divided by 200. That's our 200-day simple moving average. There are alternative ways to do these calculations. There are things known as the exponential moving average, for example. But from a simple standpoint, many investors can consider this to be a common way of looking at things. Doesn't mean it's the right way, just a common way that investors will look at the market. Now, we've talked about that from a one-year standpoint on the S&P 500, right? We can do the exact same thing in a weekly chart as well. And in my case, I'm just going to hit this arrow to my weekly viewpoint, and everything we just discussed is still right there on the chart. But you can see this is going back quite a ways, everybody. This chart, I can take this all the way back. This is set to the maximum. This is a weekly back to 1991. And what I think that this chart reminds us of, everybody, is why the long-term investor feels so comfortable putting money to work and not necessarily selling. When time is on your side, which is to say your time frame for investing is 10 years, 15 years, 20 years, time is on your side. You are afforded the chance to make mistakes early on. For example, maybe a buyer of stock today doesn't feel great about that investment in 6 months or 12 months. Maybe it's down 20%, 30% or more. But historically speaking, the market goes higher in the long term. So with that in mind, it might be rough for 6 months, 12 months, 2 years, but the thought is that investment nonetheless 10 years down the road will still be better than not having put that money to work. Okay, so there are many both anecdotal as well as calculated detail that will validate the long-term thought process. And I know for many of you, if you pay attention to the market every single day, you will often hear about the so-called risks on a day-to-day basis. And truth be told, on a day-to-day basis, market movement is commonly what we would call noise. Doesn't mean it's not opportunistic for the trader, the short-term investor, sure. But for the long-term investor, the individual who's only concerned with putting money to work, I'm not concerned with, am I selling that stock tomorrow or next week or even later this year? They're concerned with investing for the purpose of bringing long-term returns. Well, a chart like this one in the S&P 500 is a great reminder that yes, you can put money to work at highs and still do okay. But if you are a calculated investor, you will find that the instances when it is most appropriate to put money to work is right after or right in the midst of what feels like the absolute worst market you've ever seen. And that's the challenge to so many of us as investors, because inevitably we want to feel good when we put our money to work. Well, when do you feel good? When you see stock trading at new highs. It's very hard to be a buyer in the midst of, this move right here, right? This was January of 2022, and we dropped in the S&P 500 very quick from this January to our bottom in October. We fell 27.5% over that window. So that was 40 weeks, 41 bars, 40 weeks of our year before we bottomed out, and we're down 27%. And it is very difficult, but that was, in hindsight, as is always the case, that was the time where a trader could have said, boy, we are off X percentage. Now I need to deploy. I need to get some money in there. But this is why the investor needs to have some basic understanding of technical analysis, but also perhaps some basic rules with which they will work to deploy money on a long-term plan. Okay, so do we feel really great about where we are right now? I mean, look at the S&P was a peak just shy of 6,100. We're now 230 points off of our peak. I mean, goodness, everybody, it's not a big move, right? As we sit here today, we were off maybe at one point as much as 4% from our peak. So it's easy when the market is doing wonderful. We all are comfortable buying at highs when the belief is, oh, there's nothing wrong. We're always going to be afforded to buy at highs and keep going. But we often need these pullbacks to give us the opportunity to continue to move higher. It is really these extended moves, that lead to bigger selling. And I know one of the comments that I wanted to make sure I spoke about today is this concept that the market's set up for a crash. And I'll just remind you that I think terms matter. I think terminology matters. And the idea that the market is ever set up for a crash is just seemingly nonsensical to me. Mainly not because the market doesn't crash, it does. But the point is, we go higher in slow fashion, right? We grind our way upward. The challenge that we undertake is believing that the grind will continue unabated. And what happens most consistently is we get nice little retreats. In the midst of strong trends, we get small retreats, like, looking at the orange line here, the 20-day moving average worked so well, or the 50-day moving average worked really well. There are many, many instances where pullbacks to the 20-day moving average bring more buyers until they don't, right? Or pullbacks to the 50-day bring more buyers until they don't. The point being, slow and gradual up and quick and speedy to the downside. That is the takeaway. You got to be comfy with that. And if you're good with that, then you're probably able to manage the day-to-day noise that the market gives us. And again, perfect. AP 514, completely agree. Stairs up, sometimes the window down, sometimes it's the escalator lower, sometimes it's the elevator, sometimes it's the elevator shaft, sans elevator itself, right? Sometimes it goes that way. But the challenge that we traders, investors alike need to have, we need to accept, is that those instances will occur. Importantly, how do I want to act when those instances occur, right? You're going to be wrong. At times, we're going to be wrong. Admitting that up front is a good idea. But having a plan that says, I'm an investor, I like to buy at long-term trend levels, commonly something like a 200-day moving average as an example. When you get nearer the 200-day moving average, traders tend, or investors both alike, tend to say that might be an area where I'd like to deploy money. But the reminder I want to give you all is that if you are an investor and not a trader, then the investor is far less concerned with, is today the absolute best price? No, probably not, right? We're not trying to so-called buy the bottom or sell the top. That's not the process by which we're going to be successful. We're going to be successful by having an understanding of how the market acts, what is common versus what is rare, and where do we decide to get that money really to work, right? I think that makes a lot of sense. So, from an investor standpoint, maybe that value standpoint, the individual says, the market's been grinding higher, the S&P up 20% back-to-back years. If we could get a pullback in the level of 15%, 20%, I'm going to swallow hard and put money to work. That's going to be hard at that time. You might today be saying, I can't wait to see the S&P at 55, 60 because I would love to buy up that 200-day moving average. And you might say that today until we get there. And then you see it. And the day that it happens is a volatile one. Maybe it's based on a news headline of some sort, right? That's the hardest part, is the emotional tie to your dollars will keep you from doing what you've stated you wanted to do previously. And if you allow your emotions to get in the way, it can keep you from doing the right thing. So today, what I want you to do, and I'll point this out because I'm not going to be back with you next week. I'll be out on my way out to San Diego for an upcoming workshop that we have. But when I return, we are going to get full throat into the discussion about all of this. And so what I want you to do over the next 2 weeks till I get back is at least give some consideration to who you are, all right? Do you wish to be investing? Do you wish to be trading? Are you investing and trading with growth type securities? Are you investing and trading for value type securities? What about income? Is income a part of the process? And when I say income, I don't want you to think about it from the standpoint of trading for income. More specifically, are you investing to get income from your investments? Meaning, are you buying fixed income investments? Are you buying equities that pay income? That is the thought process I want you to consider. Now, one of the things that I touched on originally that I wanted to point out were some preset watch lists that are available to you all. Those are in the dividend category here, everybody, the 25 plus year dividend and 50 plus years of dividends. So these stocks are essentially companies that have paid dividends for 50 plus years. and then, of course, those that have paid for 25. Now, these are available under the public watch lists and right at the top. Okay, so there they are. 25, public, the first one. 25 plus year dividends, 50 plus year dividends. Okay, so I wanted to give you guys those. So make sure you recognize that those are available to you. And then what I've done internally, at least, prior in kind of working to build this for us, I've created some value watch lists, growth watch lists, and income watch lists that I am going to share with you, but we're going to do that at another time. So because I'm not covering that today, I'm not going to share those watch lists at this point. I'm going to share them in a manner of helping you build them. I won't be able to share the list itself, but what I am going to do is take us into Schwab.com, and we are going to work through the stock screener tool and then access that, build the list. I'll show you how to do what I did basically, so that you can create lists that kind of fit with what you're looking for. I'm going to give you some generics as we do that. Like I said, some ideas on what is defined as an income list, what is defined as a growth, what is defined as value. But hopefully that gives you the framework with which you can build this on your own. And then, yeah, exactly. That's right, Wiley. I'm just setting this up, just a little tease of what's to come in this particular class. So that's what we're going for. I wanted to answer Zor's question. Yeah, this one won't be necessarily like small balance investing, but what I'm going to lead you toward is an understanding that your balance isn't as important as the percentage of your balance devoted to those positions in the portfolio can absolutely be an available process that you can work with, even regardless of your account size, I should say. Regardless, should absolutely be a concept or a framework, if you will, that you can use in building your plan, building your process for, getting more familiar, more comfortable, and deciding how you want to do things here. I should also mention that while I'm taking this over, there is a, let's see here, I've got the class, here it is, on the page. If you are wanting to, you can always go back and review last year's segments. So if you wanted, for example, just use that little magnifier right here and just type in getting started with stocks, and we will take us right to, so here's the class we're doing right now, of course, and then here's Connie's playlist from last year. You can hit that full playlist and go back in time. So if you want to get ahead of things, please feel free to come right here and do just that, everybody. But recognize I will be back with you all in 2 weeks, and we're going to really kick this off and get down to the nitty gritty, if you will. We're going to place some example trades in my brand new example portfolio that is refreshed and ready to go, but all cash, ready to deploy some funds. But we're going to do that at proper times as we work through the discussion on growth versus value versus income, etc. So a lot to gather as we go forward here. So at this point, we're going to wrap it up. I want to thank you all for being here. I'd love a couple things from you, though, if you don't mind. Number one, make sure you're subscribed to the channel here, everybody. The YouTube coaching channel, Trader Talks. There's a subscribe button right here. If you don't see it, it's because you're already subscribed, everyone. So hit that button if you see it there. Also, follow Connie and me on X, Kevin Horner CS, Connie Hill CS. And lastly, hit that thumbs up button for us down below. We're going to get this one into the archives as well to kick off the 2025 year. But moving forward, that thumbs up helps us so much in the YouTube algorithm. So my hope is that we can continue to spread the news, if you will. So with that, thanks to all of you for joining me today. Big thanks to Connie Hill in answering my questions here, or rather the questions that all of you posed in the chat for us. Hit us on X if you got additional questions. And if you're finding us in the archive, remember, use that comment section down below if you've got questions as well. And that's it for today. Hope you all have a great rest of your Thursday. I will be back with you all tomorrow morning for Trader Talk. Remember, that is Friday session, no archive. So if you're looking for Trader Talk, 9:30 a.m. Eastern tomorrow morning with the market open, live exclusively. See you there, everybody.